Good morning, good afternoon, good evening, everyone. So welcome to the paper session 8, Asset Allocation and Climate Change. My name is ZHONG from the University of Western Australia. It's my great pleasure to chair this session. We will have 3 papers in this session. For each paper, there will be 20 minutes presentation followed by 5 minutes Q&A. So now let's start from the first paper. The first paper, the title of this paper is Who Owns the Emission, Active Ownership, and the Carbon Underground 200. The presenter is Truzaar Dordi. Now I will hand over to Truzaar. Truzaar, could you share your slides? Please unmute yourself. Okay, great. Please unmute yourself.
All right.
Okay. Yeah.
Fantastic.
Really good.
Great. Thank you. Okay. So thank you so much for the introduction, Roy. Thank you for having us here today, and good morning from sunny Waterloo, Canada. My name is Truzaar Dordi. I'm a PhD candidate at the University of Waterloo. I'll be presenting the second paper of my dissertation, written in collaboration with Dr. Sebastian Gehricke at the University of Otago, Naef, Dr. Alain Naef at the Bank of France, and my supervisor, Dr. Olaf at the University of Waterloo, and on the topic, who owns the emissions? The paper is currently in Revise and Resubmit at the Environmental Innovation and Societal Transitions Journal. And I'll just begin with a bit of a personal context. I've been studying fossil fuel divestment in both research and practice for over 6 years now, and one of the most common rebuttals I hear, especially by shareholders, is that they'd rather engage with the industry. So I want to understand shareholder influence in the fossil fuel industry. Who exactly has that control, and does that control matter in influencing corporate governance? So if you're not familiar with the Carbon Underground 200, it's a group of 100 coal and 100 oil and gas firms based on the size of their potential reserves. And what's unique about looking at this potential reserve is that they're an indication of future emissions potential. And these reserves are so large that if they were burned, we would surpass our carbon budget 3 times over. So there's this critical need to constrain these reserves if we are going to be meeting our climate targets. Do capital markets have a role to play in this? We argue yes, that's what we're here for. But the role of private finance in actively constraining emissions is yet to be explored. But before we can look at policy solutions on how to do this, we need to ask who owns these companies. And we ask this question in 4 ways in this study: through the lens of spatial finance, through sensitivity to shareholder influence, centrality mechanisms by shareholder type using network analyses, and through carbon exposure. And we'll discuss each of these in more detail as we present the results. And what we find in this study is just 10 actors own the majority of the Carbon Underground 200, and we argue they can thus drive a sustainable transition in the industry. And there might be precedents to do this with increased climate-related financial risks, the proliferation of net zero commitments. Shareholders might be more willing than ever to engage with the industry in a manner that aligns with their mandates. However, on the flip side, we argue if they don't engage to restrict production, investors should be held accountable for financing the economic activities that directly contribute to climate instability. Just briefly on the literature, I mentioned the Carbon Underground 200, but it accounts for 98% of the proven coal reserves, 98% of the proven gas reserves, and 97% of the proven oil reserves held by publicly listed companies. The burning of these reserves will contribute an additional 674 gigatons of carbon emissions, which is 20 times greater than our global 2019 emissions and 3 times greater than our global carbon budget. Generally, policy discourse around emissions is largely dominated by demand-side solutions. We're looking at carbon pricing, energy retrofits. But what we need potentially, as Green and Dennis 2018 would argue, is restrictive supply-side solutions as well, what they coin cutting with both ends of the scissors. So we have to constrain the absolute amount of combustion, both through demand-side policies and supply-side solutions, moratoriums on production, for example. And these supply-side solutions may actually be quite effective. They would slow investment in fossil fuel production, they would limit carbon lock-in, and they would reduce stranded asset risk. Yet the potential of supply side financing is still secondary generally in policy solutions. So capital markets have historically been instrumental in supporting economic transitions. Perez 2002, for example, speaks to the role of finance in the Industrial Revolution, in steam, electricity, telecommunications, and certainly they will be just as vital in the sustainability transition as well. But compared to the vast literature around mitigating risk, the role of finance in propelling a low carbon transition, specifically through supply side solutions, remains largely fragmented and unexplored. So to design these effective supply side solutions, we first need to know who these shareholders are. And before we do that, even we need to recognize that the potential influence of each shareholder will differ based on different shareholder characteristics. And consequently, the successful points of intervention will also differ. Interventions, for example, from an investment management firm who own small investments in many firms will be wildly different than a government who owns sizable holdings in a few large companies. Notably, this study doesn't take a position yet on what these owners should do. That might be future work. Rather, it maps market structure of equity ownership to identify those with greatest potential influence. And the decisions by these shareholders alone could, in recognition that these decisions by shareholders alone could influence future emissions potential and climate instability. So I mentioned the Carbon Underground 200, our sample of firms and their associated emissions are provided by fossil-free funds. Equity ownership data was collected from Bloomberg in February of 2021. Bloomberg provides ownership data for all owners greater than 0.01%. So that's what we collected. And particularly what's novel to this study is that we also included indirect holdings, a second layer of ownership for select shareholders. So corporations, holding companies, trusts, venture capitals. We also looked at who owns those corporations as well. Those shareholders, I apologize. This, we include this because they also might be affected by climate-related financial risks and consequently may also be able to indirectly influence the industry. And through this process, collecting the direct and indirect shareholders, we identified a total of 918 distinct shareholders for this study. The method is divided into two sections, a spatial analysis and a network analysis, and I'll speak to each method in more detail as I present the results. But overarchingly, the spatial component includes the regional distribution typology between shareholders and the firm, a brief discussion here around the nature of carbon leakage. That's followed by a sensitivity analysis also at the regional level where we look at the debt to capital ratio and Herfindahl-Hirschman index. We then turn to the network analysis where we present bipartite network graphs. They're used to understand the structure and dynamics of real world networks. And we can compare these networks quantitatively as well using a few centrality measures, which we'll again discuss with the results. Finally, we present a novel ranking method, which combines equity holdings, carbon emissions, and network centrality measures. And that is used to identify the most influential shareholders. All right, so beginning with the spatial distribution of ownership, this is based on work by Wojcik et al. 2019, and the typology is presented in the gray square at the bottom left there. Domestic ownership, for example, is a domestic shareholder which owns a domestic firm on a domestic stock market. And domestic ownership, based on the visualization to the right, is the most prevalent with the United States on top. And that's followed by import ownership typologies. So this is an example where a US shareholder with holdings in a Canadian firm are traded in a Canadian stock exchange. So this distribution, particularly on the import ownership, is interesting. It opens conversations about a form of carbon leakage, who is producing and who is profiting off that production. The visualization highlights the fact that wealthy nations, particularly America, are investing heavily in pollution abroad. I will briefly note the limitation that the fossil fuel firm might actually conduct their production business elsewhere, but we base this analysis on the firm's headquarters, as that's where the regulatory environment in which they work in. The next piece is the sensitivity analysis by region, which complements Wojcik's typology. And here we examine how reactive firms are to shareholder influence. The Herfindahl-Hirschman index, as well as the debt to equity ratio that I'll present next, replicates work by Galaz et al.'s Finance and the Earth System paper. And we examine the sensitivity at the firm level and then aggregate it to the country level. So beginning with the Herfindahl-Hirschman index, it's a measure of market concentration, and this can be read as countries with a high HHI indicate monopolistic ownership. Countries with low HHI indicate competitive marketplaces. And it'd be no surprise to see the Kingdom of Saudi Arabia, for example, which owns the majority of Saudi Aramco, and some of the more competitive markets indicate that firms in those regions have many small owners instead. The debt to equity ratio, also inspired by Galaz et al., is a measure of how heavily a firm relies on debt financing, and consequently how sensitive a firm might be to external financiers. And this might be because a country has higher infrastructure costs, for example, where an investor might push to utilize equipment to the end of life. Again, these results are aggregated to the regional level for this analysis. So moving towards the firms in more detail, we start with this stepwise reduction in ownership structure. This replicates work by Carroll and Hujser in 2018 here. Three quick takeaways I want to point out. The first is that the vast majority of investors actually hold a relatively small proportion in any one company. Over half of the sample owns less than 1% of ownership in any one company, and 3/4 own less than 2%. Second would be that the investment advisors like BlackRock, Vanguard's, Fidelity's are the most prominent, under 5%, which means they generally own a small proportion in many firms. Whereas on the flip side, governments and corporations are the most prominent, over 10%, which means they typically own very large shares in few companies. Getting into the network portion of the analysis, we build a collection of bipartite networks. This is inspired by Baggio et al. 2020. And bipartite networks typically have two node types: a shareholder and a firm with a directed link of ownership. The shareholder would influence the firm. Variability between shareholder types can also be measured quantitatively, and this allows us to rank network types according to their relative centrality scores. We use two centrality scores in this study. We use the degree centrality and closeness centrality, and these positions serve as proxies of relative influence, prominence, and prestige of the shareholder in the network. So really quickly, degree centrality is quite straightforward. It's simply the number of edges that a node has, edges being the lines, nodes being the blue dots. This can be normalized, of course, as well. So in social networks, you can think of the friend who knows everyone. And in the blue network example to the center, that would be node B. On the flip side, the closeness centrality evaluates how close a node is to all other nodes in the network. And this is an indication of the shareholder that has close relationships with many firms and shareholders. They're the person who can bring groups of friends together, for example. And again, looking at the example visualization there, for A or C to interact with D or E, they would go through B. So again, B would have a high closeness centrality there as well. So from the visualization of the entire network to the right, this includes all the shareholders. Some nodes with low degree centralities are seen in the orange square on the top. These are firms with maybe one or few shareholders. We also see some deeply connected nodes with high centralities, firms with many small shareholders right in the center in the green square, and instances of high closeness centrality as well, where a small cluster within the center of the blue square at the bottom there, the small cluster of gray shareholders links several different red firms as well as their shareholders to the larger network. So we break this down by ownership type. And again, we see that networks vary widely. Norges Bank, for example, is under the public. The first visualization there, Norges Bank is the blue dot in between the sea of red, and they have many small holdings in many firms, for example. That's how you can read one of these. Equity investors tend to also have many investments to the top right there, and high degree centralities. And in contrast to that, pension funds, high net worth individuals, banks, corporations on average have less than 2 companies they invest in. And of course, we can test this variation as well, quantifiably to see how different owners may have different influences. Public corporations, pension funds, high net worth individuals have fewer edges than nodes. Saudi Aramco, for example, only has 1 edge connected to the Kingdom of Saudi Arabia, as I mentioned. And this relationship would be confirmed by the degree centrality measure in the 3rd column. Comparably, between us scores indicate that investors would play an important informational role in the network with a high between us score. And may consequently be able to influence corporate governance of the entire industry with greater ease, and we can sort of design policies alongside that. And certainly for those with high between us scores as well, collective action may be more impactful in the network. You can again think of them as friends that bring other friend circles together and are able to communicate and influence social plans between those networks. And finally, what I think is perhaps most interesting, we score and rank each shareholder using a combination of their degree measure and a portion of emissions held within the sample. I will note here that we don't allocate emissions to any one shareholder for methodological considerations. What we do is identify which stakeholder can collectively have the greatest impact through a combination of their influence and their collective holdings. Investment advisors, sovereign wealth funds, banks all have higher degree scores. They're more central to the network through numerous holdings, but lower cumulative emissions. Whereas governments, in contrast, often have few but very, very large holdings in the Carbon Underground 200. Emissions measures are high, but their degree measures are low. I will also note that we did also list up to 10 shareholders in each subsample in our paper as well. So if you're interested in a deeper examination by shareholder type, please do feel free to reach out for that. And I'll just close by saying emissions constraints can be championed by a small group of shareholders. However, there's a recognition that their network structures will warrant different forms of policy solutions. We identify the structures of equity ownership in the Carbon Underground 200 in this paper, and we conclude through that the decisions by financial actors have the potential to influence future carbon emissions and therefore influence climate instability. Could these shareholders adopt measures to curtail fossil fuel production? Traditionally, agency theory would argue that shareholders would only exert influence in a corporation to increase firm or shareholder returns, not necessarily to restrict production. But as shareholders begin to commit to net zero emissions, owners may be more motivated to align these investments with their own carbon reduction strategies. On practical contributions, supply side constraints through private finance mechanisms can be utilized to restrict emissions. However, the network structures, again, will warrant different policy solutions. But more so what this study does is it also exposes the shareholders with the greatest potential influence as a means to pressure them to adopt more aggressive supply side interventions. And finally, I'll close off with putting a call for sustainable finance scholars to give greater merit to who and how financial actors contribute to climate instability and their role in furthering carbon constraints. Thank you so much for your time, and I'm looking forward to your questions.
Okay, thank you. Thank you for the excellent presentation. So I got 2 questions from the audience. Question 1, are your network results consistent with the findings of Dimson et al. 2020 on coordinated engagements? For example, that you see that lead engager are located close to the target,
Yes, the paper doesn't come to my mind straight away, so I'll have to look to see what exactly that the paper suggests. But certainly the individuals who are working towards coordinated engagement, for example, with Share Action Network, are those individuals like BlackRock, Fidelity, and Vanguard, who tend to be pretty high on the betweenness centrality and degree centrality scale. I would note, however, at the same time, the share action studies do suggest that the vast majority of them still continue to vote against climate-related shareholder resolutions. So, yeah, again, I'll have to look deeper into that study.
Okay, thank you. There is another question. So, where is the climate action 100 plus in your analysis?
Yeah, so again, we in this particular study, we're looking at the specific firms. A lot of these firms are already involved with the Climate Action 100 and championing engagement through those processes. I believe there is some opportunity to see statistically, you could test to see which firms are engaged with climate action as well as the other engagement groups and compare to see if those involved with those groups are invested in specific firms with lower emissions, lower reserves and lower potential emissions.
Okay, great. So actually, I have a question for you. So I think I like your paper, very interesting study. So in your paper, you just mentioned that you collect the information in 2021. So because you just analyze the relationship, I mean the connection between the institution or the shareholders of the Carbon Underground 200 firms. So my question is, do you do any kind of dynamic analysis? Let's say look at the trend, because the climate change, this has been existed for a long time, but only recent years it brought attention to the public, and we pay more and more attention. So maybe it's also interesting to look at the trend of those kind of closeness and centrality. Maybe how those kind of network change. Did you try anything like this?
Yeah, that is on the list of things to do. I completely agree. Not only will shareholder influence change, but so will the firms that are listed on the Carbon Underground 200. The amount of reserves they have, and as they also write reserves off their books, there are several different layers that will change over time, and I think it would be really interesting to examine, even if it's the past 10 years, for example, how things have changed. I'm sure it'd be quite interesting study.
Yeah, because in finance there's a line of literature to study and to examine the engagement of the shareholders. I mean, especially for institutional shareholders, they try to engage regarding to the ESG or maybe carbon emission behavior of the firms. So here in your paper, you list a couple of the big financial institutions. I mean, nowadays, I believe most of those financial institutions send the PRI. So that means they should incorporate the responsible investment principles into when they make the investment decisions. So after they sign the PRI, so that means they made the commitment. So that means once you made the commitment for the climate change, so you need to do something, right? So it's also very interesting to see, what kind of financial institution they made the commitment and what's their actions. I mean, this is also related to my previous question. So if you can show some kind of change, that would be also very interesting.
I appreciate that. I think it's absolutely this piece on engagement and groups of climate action and PRI. Definitely a lot of opportunity there to look at how that's affected decisions over time. So I appreciate your question as well as the questions by the audience.
Okay. Okay, so thanks again for your presentation. Seems like we don't have the question right now. Maybe you will get question later. Now let's just move on to the second paper. The title of second paper is Understanding Macro and Asset Price Dynamics During the Climate Transition. This paper will be presented by Steffen Hitzemann. Steffen, now I will just pass over to you.
All right. Yeah, thank you very much. Yeah, I'm very happy to be here to present this paper called Understanding Macro and Asset Price Dynamics During the Climate Transition. And this is joint work with Michael Donadelli and Patrick Grüning. So I will give you a bit of a motivation. I mean, as we all know, the world needs to move towards a low carbon economy if we want to avoid the dramatic consequences of climate change. And so this transition is also driven a lot by policy measures, of course, that are implemented, like carbon taxes, cap and trade, and so on. And we're interested in this paper in the relation of financial markets and macroeconomic quantities during this transition, right? And we know in finance that the reallocation of capital usually responds to signals from financial markets according to Q theory. For example, right? So what do we want to do in this paper? So we want to understand in more detail the interaction of asset prices and macroeconomic quantities during the climate transition. First, we have one very important empirical question. So the empirical question is basically, has the US stock market started pricing the climate transition, and how can we see that potentially? Where can we pin it down, right? And then we have a theoretical model, basically a macro finance model, which asks, okay, standing where we're standing right now, how will the climate transition affect asset prices in different sectors, and how will the cash flow and risk premia effects that we can observe interact with macroeconomic quantities and also speed up or slow down the transition to a low carbon world economy. So that is basically what this paper is about. So we're going to start with the empirical analysis. And this is actually not the only paper that has looked into the question, okay, is the climate transition now priced in the financial markets already? Are climate risks priced? But the literature has come to some, controversial results so far. So, I mean, there are papers by Bolton and Kasperczyk, and they find that stocks of firms with higher total CO2 emissions, they earn higher returns, right? So in short, I will for that write, RD is greater than RC, which means, we say the dirty firms, right? So the dirty firms have higher returns nowadays than the clean firms. Okay, this is what this paper or these papers find. Then there is another paper by In Park and Monk, who find that an investment strategy of long carbon efficient firms and short carbon inefficient firms actually creates an positive abnormal return per year. So that would mean RC, the clean firms, have a greater return than the dirty firms, right? And then there's another paper by Garvey, Iyer, and Nash, which also finds something that is more in those lines. RC is greater than RD. And so in our paper, we say, all these results, they depend a bit on the classification. So there's like scope 1, scope 2, scope 3 carbon emissions and so on, and it depends on your overall approach. Here we want to take a very simplistic approach by saying, okay, we know one sector that will be very much exposed to climate policy measures, and that is in the main focus of the climate transition, and that is the fossil fuel or the oil sector, right? We clearly know that is a dirty sector, and we will basically use that to say, okay, this is where we can probably most easily pin down where the climate transition already has an effect on stock market valuations, right? So now what I want to say next is basically we need to do a sophisticated analysis of that, right? Because by simply looking at some quantities visually, that will not really lead us anywhere, right? So for example, we can look at oil minus market returns, and I could give you a different interpretation. I could say, okay, here they are positive, here they are negative, but it's not really clear. In such a picture, we cannot see that, right? Similarly, if we look at price dividend ratios, you could argue now, you could argue anecdotally, they are high now, they are low now, who knows, right? So it's really hard to pin it down. So therefore, I just want to say what we need here is a thorough empirical analysis of the question, are the valuations, the market valuations of oil firms and fossil fuel firms, are they currently high or are they low? And have we seen a trend of these valuations of oil firms and fossil fuel firms together with the awareness for the climate transition by financial market agents, right? So we need a thorough empirical analysis here. And the good thing is that there is, some methodology more or less that has been established by papers, by Stolz and co-authors. So these papers always look into questions that have to do with valuations and trends in valuations. For example, are big banks, for example, valued more highly than small banks and so on, right? So are boring industries valued more highly or valued more, less highly than less boring industries? So we have a methodology here to look into such type of question. So we're going to use the market to book ratios as a valuation measure of the oil firms, right? We're going to employ a panel regression setup to control for market-wide valuation trends, right? Because we also know market-wide valuations overall in terms of market to book ratios have been trending over the last years, right? Due to other effects like loose monetary policy and so on, right? And we basically want to analyze whether the oil sector's valuation has changed with the increasing awareness for climate change risks. Okay, so now the first part is, how do we measure the awareness for climate change risks, right? And for that, we have constructed a relatively simple, we call it climate change risk awareness index, right? So this is measured through Google search volumes and Google books mentionings of words, right? And we're basically interested here in this blue line. So this is what we call the climate change risk awareness. And you see here how this has changed over time, in particular, how it has trended, right? So it has trended since 1995. That's where it basically started. And now it has continuously trended to basically all-time high levels nowadays. Nowadays, the climate change risk awareness is highest. And this is what is measured very nicely by this climate change risk awareness index. You can also see here in the gray dashed line. So this is the ratification and the adoption of the Kyoto Protocol. So it seemed to, really take off during those times. And what we're interested now is basically this trend, right? So we say, this trend kind of started in 1995 and kind of, went up since then. We're not so much interested in our study in the fluctuations around this trend. So, that it went down slightly here in 2005, 2006. This is not really so relevant for us. So we're mainly interested in this upward trend in the climate risk awareness, right? And we're asking basically now, have the market to book ratios of the oil sector declined with this increasing trend in climate change risk awareness? And we're comparing basically the market to book ratios of the oil sector to the whole market, right? And we're looking at the whole CRISP CompuStat universe, right? We use several control variables. You will see that also in a second when it comes to the results. And again, we're asking, have these valuations changed relative to the overall market with this trend in climate change risk awareness? Okay, and we have the results already here. So it's a panel regression setup. And to jump directly into the results, what we're mainly interested in is what I have in bold here. So this is an interaction term, right, between a dummy variable for the oil sector, right, and the climate change risk awareness index. Okay, and this term basically tells you the result. Okay, has the overall valuation of oil firms of the oil sector changed with the increasing climate change risk awareness relative to the overall CRISP CompuStat universe of firms? Right. And okay, what do we see here? We see a negative coefficient, right? And we see a highly significant negative coefficient of a certain magnitude. So that means the first message here is, yes, it's correct. The valuation of the oil firms in the CRISP CompuStat universe has changed relative to other firms with the increasing climate change risk awareness. This is highly significant. And it is also a negative coefficient, right? So this is in line with our expectation, right? Because we were expecting, probably it will be harder in the future for the oil sector. So the valuations will probably be lower a bit. So with the increasing climate change risk awareness, we have lower valuations for the oil sector. And this is exactly what we find in here. right? Just to give you an idea of the magnitude. So this coefficient of, let's say, 0.13 or 0.15, right? So we have to understand the magnitude. We have to see that the climate change risk awareness has since the year 2000 increased by about 100 percentage points in here, right? So we have to take this value times 100. So that means the market to book ratios have declined by about 1.3 in the oil sector relative to the other sectors. And the average market to book ratio is about 3.2, 3.3, right? So that means, in summary, you can say, based on these results, that the valuation of oil firms has declined by about 1/3 relative to the valuation of other firms, with the increasing awareness for climate change risks. Okay, and this is one of the main results that we find here empirically: lower valuations for oil firms and fossil fuel firms. You see that it's confirmed for overall fossil fuel firms, including coal firms. On this slide, basically you get almost the same results because the oil firms are very much dominating the sample, and that is what we find in here. Another interesting analysis is if we use yearly dummies, right? So we basically conduct the same regression setup, but we introduce yearly dummies. So we don't really have to introduce this climate change risk awareness index, but we basically extract a relative valuation measure of the oil firms relative to the other firms by computing this oil market to book coefficient, right? And we show an interesting pattern here: the market to book coefficient of the oil sector. So that means the valuation of the oil sector relative to the other sectors. It typically goes up and down. It typically fluctuates together with the real oil price, right? Which also makes sense. I mean, this sector, what it does is basically it produces oil, right? And therefore, the valuation of the oil sector in the financial markets typically fluctuates together with the oil price, okay? But we see also a kind of like a structural break in here, right? So there was a point when at some point these two things disconnected. So the current oil price and the valuation of the oil fossil fuel firms, it kind of disconnected here at some point, right? And so yeah, this is exactly, so we can, analyze this more formally. The correlation between the real oil price and the oil market to book coefficient used to be 0.52 and highly significant from 1970 until the year 2000, but from 2001 until 2018, which is the end of our sample so far, we're going to update that soon, the correlation is 0.08 and in fact not statistically significant. So which also tells you that the valuation of the oil sector in the financial markets has decoupled to some extent from the current oil price. And the reason, according to also our theory and so on, is that we have another effect here, which is the climate transition, which tells you the current oil price is not necessarily so relevant anymore for the future revenue prospects and valuations of the oil firms, because we also know that very soon in the future, more or less the oil sector and a lot of the oil firms will be replaced to some extent by other energies, and therefore the current oil price is not so significant anymore for the current valuation and the future revenues of those firms. Okay, so this is what we find empirically. So to answer the question, has the financial market started pricing the climate transition? Our answer is clearly yes. And you can see this very nicely if you focus on the oil sector and if you basically work with the special features that the oil sector has. On the one hand, that it is clearly a very dirty sector that is very much exposed to these climate policy measures. And secondly, that for the oil sector, there always used to be a very good matrix for predicting the valuations of the oil sector, which is the oil price. But we have seen a decoupling of that, and this can only, logically only be the case because we're now in a different regime where people see the climate transition as a new risk for the oil sector, basically. Okay, so in the second part of the paper, we basically develop a macro finance model to make also predictions, right? So how will things develop in the future? So just to give you, a bit of an overview here in a nutshell. So yeah, we have households and so on. We have in the model, we have similar to the data, we have dirty firms, we have clean firms. And the idea is that dirty firms are basically fossil fuel consuming firms, right? And dirty firms, they produce greenhouse gas emissions. Greenhouse gas emissions lead to an increase in the world temperature, and that leads to a decline in environmental quality, right? So there we will then in the end have such a basically carbon externality. And then we have a regulator in the model that can introduce a carbon tax in the model, right? And the carbon tax, of course, is also subject to certain shocks, right? So the regulator sometimes decides, okay, we're going to increase the carbon tax, and this way we can analyze what effect does it have on the financial markets and on the different macroeconomic quantities, okay? I'm going to skip the details of the model. So we have damage functions in line with Nordhaus and so on. We have Epstein-Zinn preferences, which is kind of interesting when it comes to the financial setting. What we can basically do in the model, let me directly skip to the results, is we can initialize the model at the current state, at a certain state. So we say basically in the year, for example, 1995, that is the beginning of the climate transition. So we're going to initialize the model at a pre-transition state. And then we can simulate the model, how it evolves over time through the climate transition towards a post-transition state that it reaches at some point, potentially in 2150, like in more than 100 years from now, right? So this is what we can use the model for, and therefore predict a bit what we expect to happen over the future. And so just, to give you a bit of an introduction, so we can introduce different tax scenarios also in here, right? So interestingly, I mean, people are always interested in the optimal carbon tax path, right? Under Epstein and Zinn preferences, which are often used in the financial markets literature, right? It is actually quite optimal to start with a very high carbon tax, right? To already, nowadays we would already need a carbon tax. So this is kind of here in relative units, but you would already need a carbon tax of like $120 or even higher, and you would directly jump to that level. And this is basically in line with a paper by Daniel Litterman and Wagner that was also published in PNAS in 2019. So, in line with that, we can look at different tax scenarios. So with the lower intertemporal elasticity of substitution in the model, you get, a different optimal tax path. We actually assume that the way that it works in reality is that the regulator slowly converges to this optimal tax path, right? So that means currently it's still very hard to implement such a high tax because of the acceptance of a carbon tax also in the public and so on. But the regulator will slowly converge towards the optimal tax in the longer run. And then just to introduce some of the basic quantities, so we can show then in the model, so that of course, depending on how your taxes are going, emissions will drop, right? The temperature will increase, and you can see already in here that going forward, under the optimal tax scenario, so if the regulator were to follow this green scenario, you would be able to kind of contain global warming to around 1.567 degrees, right, relative to the normal levels, right? On the other hand, under our assumption that the regulator converges much more slowly towards this optimal tax, we will come very close to the 2-degree scenario, right? But in any case, if we have carbon taxes that are converging to this optimal tax over a relatively long time, we will still be able to contain the 2 degrees scenario. And environmental quality also drops in line with these dynamics, but it is contained here at some point. Okay, so these are just some basics. I mean, this is basically just the climate temperature part basically of this model. So what we want to move to now is our transition dynamics and our financial markets valuations also, and the related effect on macroeconomic variables, right?
Steffen, you have 5 minutes left.
Okay, that's good. So we start with the Tobin's Qs. So, and this is very similar to market to book ratios, right? So Tobin's Qs, market to book ratios, you can kind of compare it. And here in the model, we kind of confirm what we also find empirically, right? So in the beginning of the climate transition, where we are now, right, the market to book ratio of the dirty sector actually declines a lot in here, right? And even if you look at the oil sector, it declines even more, right, in the beginning of the climate transition. And now we can also, in the model, we can also look at the related returns, right? And also answer our question what the model and what our overall, assumptions in here would say about whether, clean firms should outperform dirty firms or the other way around in the beginning of the climate transition. So, and what we find in here is that, yeah, because we're in the beginning of the climate transition where the climate policy measures become stronger and stronger, what happens is that through a cash flow effect, right, through a cash flow effect, we have a slightly positive effect on the clean sector, but we have a clearly negative effect and negative returns for the dirty sector and for the oil sector, right? So that means, I mean, from our perspective, analyzing the oil sector, and both from an empirical point of view and a theoretical point of view, it has to be the result from our perspective that the clean sector has a greater return than the dirty sector or the oil sector in the beginning of the climate transition where we are standing right now. Why? Because we have these cash flow effects, right? So the stringency of the climate policies becomes stronger and stronger, right? And they become stricter and stricter. And therefore, we have this negative effect on the dirty sectors and the positive effect on the clean sector, right? So now an interesting question is, how will this affect the macroeconomic variables? And this is pretty much in line with Q theory, right? So Q theory says, yeah, this is actually, driving your climate transition, and this leads to a reallocation of capital in the macroeconomy in line with what you would expect, right? In particular, the macroeconomic capital and the macroeconomic investment is moving towards the clean sectors, right? The green energies, and is moving away from the dirty sectors. And this transition is mainly, fueled also by the valuations that you observe in the financial markets, okay? Now, of course, one prediction, so now you would be wondering, how would it work out in the future, right? So we have seen that the Tobin's Qs, the market to book ratios of the oil sector, have declined now in the beginning of the climate transition, right? So now the model and macroeconomic theory actually predicts that the valuation of the oil sector, it will actually increase again in the future, right? Why will it increase? Because the actual macroeconomic capital will be reduced, right? And therefore, the book to market ratio will converge rather towards 1 again, right? Because basically you're basically now you have a very low market value, but then also the book value will be reduced. And this is basically how it's going to work in the future. So we would not expect that the market to book ratios of the oil sector actually falls further in the future. But if everything is priced in by now, we rather expect a reversal of these dynamics in the future. And just to give you a very small outlook of what else the model can do. So we can also analyze risk premia in the model. So this we can do that in terms of conditional impulse response functions. So maybe I will basically refer you to the paper for that. So we have a thorough analysis also of risk premia in the model. So, but I want to stay on time. So let me actually quickly summarize the results of this paper. In the summary, in the conclusion, we have a nice summary here. So what we find in this paper is that the stock market valuations of the US oil firms have substantially declined in the last 20 years relative to other firms, right? And our conclusion is that the market has started pricing the climate transition. And what we see mainly both in the empirics and in the model is that we have a cash flow effect because we have stricter and stricter climate policies, right? And this leads to a cash flow effect, mainly finding here that the clean firms have a greater return nowadays than the dirty firms because of such a cash flow effect, right? And also relative to the oil firms. So the valuations of the oil sector are very low right now, but our prediction is actually that those valuation ratios, they revert again over the transition period because capital actually gets reallocated, and then the market values and the book values will be more aligned again for the oil firms, okay? Yeah, and the paper also allows us to analyze risk premia. And, you know, just to give you a bit of a preview, I really, would hope that you will take a look at the paper if you're more interested in that. We show something, we call it the risk premium channel also of climate policy. So that means if you have a really very much too low carbon tax nowadays, this is negative in two ways. It is not only the case that, you know, the tax is too low, therefore you don't have enough incentives to converge to greener technologies, but in addition, you also have a risk premium effect. That means cleaner industries will also have a lower value in the financial markets than they would usually have, and this is what we call the risk premium channel of climate policy. And this risk premium channel is particularly pronounced if you have abstinence in preferences, right? And we're still working on the model. We want to precisely also quantify this risk premium channel in the future. So yeah, therefore, thank you very much for your attention so far, and I'm looking forward to answering the questions.
Thank you. Thank you very much for the excellent presentation. This is a very comprehensive paper. So I got a question from the audience. Does the same valuation effects hold for other sectors, such as food and housing, which are expected to increase, in many cases exponentially? Will these sectors adopting zero net emission enhance their attractiveness for investors?
Okay, yeah, so this is a very good question, right? So we would have to look into this, right? So right now we have not looked into the food industry and the housing industry. To be honest, to some extent, our approach in the paper was also to say, let us not look at all industries where we kind of suspect that they will be affected by the climate transition, but our approach was to say, okay, let's try to pick one industry, right? Let's try to pick one industry where we really know this is really an industry that is definitely very much affected. And then the question is kind of in a very, minimalistic way, can we at least identify some effects in the financial markets for this industry, which is the fossil fuel industry, right? But definitely, I definitely understand the question. So once you have this result, right? So now we have established it for the oil sector. So now, of course, the question is, okay, do you see exactly the same in the housing sector, in the food sector? So we would have to look at that, right? There are some other papers in the literature. So it seems to be the case that there is actually some effect, but it is currently not a part of our paper so far. But yeah, I think it's a really good idea of what we could do also in the future.
Okay, thank you. So actually, I have a question regarding to your model. Your empirical evidence is very interesting by only focus on one industry. For the oil industry, this is very high carbon emission industry. So when we study the climate change risk, so there's one of the things which is pretty important for this industry is transition risk. So in your model, you just try to model the transition dynamics. So do you incorporate the transition risk? Because for those those kind of high carbon emitters, so they just try to transit their maybe their business to some low carbon models by investing into the green innovation or something. But this is pretty risky. So nowadays it seems like there are lots of papers try to examine the transition risk. So what do you think? I mean, how it's related to your model?
Mm-hmm. Yeah. So this is great because this gives me a bit of the opportunity to explain in a bit more detail how our transition risk is kind of is modeled in the model, right? So the way that we model transition risk is to say, okay, so we have an optimal tax path, right? And then we have an assumed tax path, right? So, but this, what you actually see here in the blue line is the average of what we assume, right? But this is kind of what we have here is a stochastic model, right? So what you see here is only an average, but in the model, this blue line is actually subject to shocks, right? So it could happen that you have a shock today, and that means that you're actually converging more quickly towards the green line, right? And this is what this you don't see it in here now because this what I plotted here is just the averages, right, over like 1,000 scenarios. But in each of these scenarios, you could actually converge faster or converge slower in terms of this carbon tax, right? And this is at least what we call in the model climate transition risk, because yeah, I mean, imagine that, let's say we would have a carbon tax of $50 or of $70 in the US tomorrow, or we don't have a carbon tax at all. So that is basically the risk really that the firms like the oil firms and other firms are exposed to. And this is how we model the transition risk in the model. And yeah, all the implications that we have, they include this transition risk. And that is also why you see, for example, such a great reallocation of capital, for example, away from the oil sector, right? Because clearly the oil sector is exposed very much to this transition risk, and investors want to withdraw their capital from there because this is a risk that they don't want to be exposed to.
Okay, great, thank you. So now it's more clear to me. I think it's because the transition risk is pretty important for those high carbon emitters. And another one is just about the suggestions. So when you just present your evidence, just use a Google index, just the search volume regarding to the climate change awareness. Maybe I'm thinking, maybe you can also look at some kind of exogenous shocks. For example, the sign of the Paris Agreement, or maybe in US you can also look at the president elections, because for Trump it's there's like the some exogenous shocks. Maybe so after the Trump is elected, maybe it will just the market to book ratio of the oil industry will increase. But once he stepped down, so that would be just another thing. They're also very, very interesting. Besides the climate change risk awareness.
Yeah, that's that's a great idea, right? So I think using more of an event study setup, right? So you would basically use certain events, and this would also be a way to measure the exposure of different firms, right? So you could use the election of Trump. I think, we all know from anecdotal evidence that on that day when Trump got elected, it was also kind of unexpected, and the market reacted very positively in terms of the fossil fuel firms and so on, right? And then, you could run a whole like cross-sectional thing. So this will allow you to really figure out what are the exposures, right? So which firms are more exposed, which firms are less exposed. And that would be, as you say, a complementary approach towards having this awareness index. I think that would be very, fruitful. I think it would be very nice for the paper.
Okay. So thanks again for your presentation. Now let's move on to the third paper. So the title of the third paper is Strategic Asset Allocation with Climate Change. The presenter of this paper is Shen. Now I will hand over to Sally.
Okay.
Yeah.
Hi, everyone. Can you guys hear me well?
Yeah, I can hear you.
All right. Thank you
But
for
I couldn't
having.
see. Sorry. Oh yeah, I can see your slides. Go ahead.
All right. Very happy to be here. Good morning, Canada. Good evening, China, and a good afternoon, Europe. So I am Shen, located in Toronto, Canada, working as a research associate for Global Risk Institute. A little bit of background of Global Risk Institute. We are a think tank and we support cutting edge research on emerging risks. And our main clients are pension funds, insurance, and the Canadian government. So all the research that's been presented in the sessions and in past few days are excellent, and feel free to reach out if you want some research support and having some more fascinating research on the climate risk. So today, get back to my talk. I would like to present a recent work I've been done together with my co-authors titled Strategic Asset Allocation with Climate Change. This paper is pretty much giving institutional investors a very high level or top-down strategy to convert their portfolios from gray or from the non-sustainable to a sustainable portfolio without sacrificing the returns. So I will start with very interesting motivation, which is the green investing puzzle. As a finance background, before start this project, I did not really have a lot of background on the climate change or the literatures around. So this is where I started. I looked into what exactly is our ultimate goal. It has been frequently cited that the Paris Agreement of reaching 2 degrees Celsius by the end of the century, and later on preferably to 1.5 degrees Celsius. But if you're really looking back to the document, the whole sentence is to say the goal is to limit the global warming to well below 2 or 1.5 degrees Celsius compared to the pre-industrial level. So the condition sentence, pre-industrial level, is the very subjective words because it's not being firmly defined by those policy documents. If we're considering 1850 to 1900 as the pre-industrial baseline, as you see in this picture, we are already way beyond our goal. And the yellow line represents to the average monthly moving average temperature from the land surface average temperature anomalies. And the data is from the Berkeley Earth. However, if we reconsider the baseline from 1986 to 2005, then we will still have a little bit of room to reach into our Paris Agreement target. So that is to say, this global warming is happening firmly, and the Paris Agreement is really a very subjective goal. It really gives all the community the attention that the global warming is happening. And the fact is that even after several years of climate policy enforcement, the task force, the TCFD, all those initiatives and the disclosure requirement, very little progress is being made in slowing the carbon emission. And quoted from William Nordhaus, this year he talked at AFA conference, he said, "We are still nowhere near enough to meet our goal." So as the institutional investors, this is one of the questions I've been asking a lot. What is their pain point? And what is their motivation behind moving towards green or green investment? So looking through the literature, you may find that for institutional investors, pension funds, for instance, their main incentives or the only discretion that will limit their investment behavior is the fiduciary duty. Beyond that, we don't really see too much evidence that they can gain a substantial benefit from ESG investments from those decarbonized funds. So why is that the case? Is that a real story? And that is where the story comes from. So if I am pension funds or institutional investors, what is my pain point? Of course, I am investing, or my money will be distributed or is invested for my beneficiaries, for my clients, for those pension participants. So I want to guarantee over the next 20 or 30 years, the funds will be fully funded. As a result, having solvency, a sound solvency status is one of the goals for every single pension fund, especially for the DB plans. And looking into their investment strategy, a lot of big pension funds, they have a very, very diversified portfolio. They have the exposure to the real estate, to the private and public market, to commodities, to the credits, etc. So that is, and even to international markets. While in terms of the risk management, if you're having a risk management background, you might notice that if we want to hedge down risks, potentially we can design a certain, say, put options or options, the derivatives to hedge. However, for climate risk, it's totally a different story because climate risk is systemic risk, and we're not really able to develop any thoughts of put options to hedge ourselves against the sea level rise, for instance. So that is totally a different landscape for institutional investors. So how can they do? What can they do to contribute to this social responsible investment while still stay in a business? Well, this is the chart that gives a very high level idea that comes in and many of the institutional investors are doing. So if we define our current asset portfolio as gray, they might be changing over time given the awareness from the climate change from the entire community. But given that said, if the current portfolio is defined as a gray assets, what the investors wanted to do is to replace part of the current gray ones to green investors. However, green assets, and those green assets would hold a very special feature. They might not necessarily perform extraordinarily good in ordinary time, but we want those sets of assets that will outperform the market 100% during the climate or during the disaster event or during the climate suboptimal client status in that case. So that is the idea. We bring in the risk management theory into green investment. And in real financial market, there has been quite a lot of existing financial instruments that will support this idea. So we'll talk a lot more about it. But overall, in the current market, we have two types of a green instrument. One is called a pure play green investment. That is the type of something like a green technology. It's a real company that is supporting the low carbon business, like a green technology, social responsible environment funds. So that is one type. Another type is called a decarbonized index. So it is a little bit close to our S&P 5 index, but the difference is that it have a reallocation of the composites existing in the current market indices by divesting those hard carbon footprint stock market. So that are the really two groups of green assets that we might consider if we want to move towards the green. So now comes to the research question. What I'm trying to ask is that really true? The institutional investors who are investing in green purely because of the fiduciary duty, because of the reputational purposes, and is that really true? We cannot have a win-win. In other words, we will have to sacrifice if we want to have a better environment. So in the literature, and also I think staff also mentioned about, there's a very mixed view on this part. Some literature find a positive returns from those clean or green indices or green funds. However, most of the investors still believe that it's actually compounded belief that there's no such good social responsible companies or good ones that can constantly beat the market. So here comes one of the proposed reasoning behind. I will put that at the very front. So the reason that I believe that people don't consider green funds or green invest instruments as I would say worth investment instrument is because of two phases of unknown. And the first phase of unknown, I call it unknown knowns. So these are type of the things we have enough data to do the analysis. We can find out the possibilities. So this is kind of anticipated possibilities. We probably don't know what exactly. So there are two types of unknown knowns that will be included in the paper. First is we don't really know what is the current impact of climate change on the global economy and on the financial market. It is very unclear if with or without climate change, whether the S&P 500 indices will have a what different look. So this impact has not been well analyzed. And another part of unknown, which we have seen in the literature quite well, is we don't really know the expected return. And that is a very hard to estimate. So even if we see a positive or negative return from those green funds, it does not really tell anything because it's a very hard to estimate variable. And it's so much uncertainty around that estimation. Another layer of unknown is about unforeseeable outcomes. So I'm looking into two different unknowns. First is their unknown climate pathway. So if you look into those ICPP documents, we will see that there's always a huge disparity around the future pathway of the climate or carbon emission or the temperature increase. And each pathway will be associated with a very different look of future financial market. That is to say, we don't know how the climate in the future would look like, and we don't know even further how our future financial market will be influenced by those unknown climate pathways. And another very important unknown, particularly for the investors, is the very mismatched horizons. So we know climate risk or climate change awareness takes time. However, for most of pension funds and even short-term investors, their investment horizon is quite limited, say 15 years on top. Do we have enough amount of investment horizon to see the benefits of green investment? That's a big question mark. So that both layers or both phases of unknown, I believe, will drive the myth behind green investment. Okay, how can I prove my hypothesis is correct? That is the research question that I proposed in this paper. So first, the goal of this paper, as I mentioned, I proposed a strategic pathway towards green investment. It's actually a 4-step strategic asset allocation framework, and that can be extended based on companies' needs. And another important goal of this paper is to answer what makes green investment a puzzle. Why institutional investors only consider green investment incentivized by fiduciary duty. So that is the two goals of this work. Okay, so I probably would not spend too much time on the methodology part, but very high level of the idea and some important findings in my talk. So first is the overview of the pathway. I will go through them one by one in details. So you can see it's a 4-step, start from the data collection, the modeling, the future climate scenario generation, and the portfolio construction. So it all looks standard, but there are some subtle changes that where we incorporate the two phases of unknowns. So for the data collection process, that is like, if you consider the machine learning, this is the process, the AI machine eating in the data. I put the data into 3 categories. The first is the macro. So at the macro level, we're really looking for the factors that will drive the stock market. That can be explaining the future or the dynamics of the equity market returns. So we can include the nominal rate, inflation, dividend price ratio, spread yield, credit yield, etc. So this really depends on the model, what type of model you're most comfortable with. And then the second component of data collection is the climate data. So in this case, in this paper, we are only looking at the temperature change, which is the transition data. However, as mentioned, there are many other data like the climate news, like Steffen used the climate risk awareness data, and even some disaster-oriented data that can also be included in the model, in the data collection process. And the last part of the data that we need, of course, is our investment instrument. So we need not only the standard or the regular investment instrument, which we define as the gray assets, we also collect a lot of representative green asset classes. Partially are pure play funds, and another part are called the decarbonized indices. So here give you a very quick overview of how the data looks like. So I put a green bar, and you see everything above the green bar represents to the gray assets. And those are not very, I guess those are not very new to you guys. So the stock, we use the S&P 500. We have the bond market. The liability is for the pension funds, DB plans. We use the 10-year yield as a proxy for the liability risk. And we also include the real estate, the commodities, credits, the corporate bonds, and the hedge funds. And we also include a list of green funds, which includes the green bonds, a list of decarbonized funds. And you will see the last 5, the XPP 1, 2, 3, 4, 5, those are the pure play funds. So there's a very interesting feature, as you see, those pure play funds, they existed for less than 15 years, and they are super volatile. And you will see a lot of them have negative expected returns. So that was probably one of the reasons the institutional investors are sluggish to jump into that market. However, it might not be the full story. So here comes to the second step, which is the modeling part. In the modeling part, our major goal is to solve the first part of unknown, which is unknown knowns. So we have a lot of data. We can look into the impact. What is the current impact of the climate change on the asset classes? So in this paper, we employed the vector autoregressive model. And within this model, we include temperature change as one of the risk factor, and to see how the change of the temperature will influence, can explain the equity market of different kinds. So in the table below, you will find a very interesting outcomes there. So we see that, so I only captured the coefficient that is driven by the temperature risk. So for the S&P 500, the stock market, it actually has a negative coefficient. That means with the warming in the future, or this warming, if warming is getting positive, so that means if the global warming is not stopping, the future stock market are expected to jump. However, on another end, in the second line, I put them in the green color. These are those green instruments, and I select some of them. Not all the results are significant, unfortunately, but there are some very interesting results. For example, the social responsible index, it actually has a strong and a positive relation with the warming. Same is with the clean technology fund. So that is to say, if the warming is going on in the future, the global warming continues, you will see a positive return. And that is exactly the direction that we have missed. So how are we able to implement this relation, very important relation, into our portfolio construction process? So that comes to the very next step. So far, we only know this relation, but one of the most important ingredients we don't know is what is the future path of the temperature change. And that is how this is the third step. We're trying to implement the future climate scenarios into the expected return valuation. So in this case, the X is really, XA is our expected return from the standard financial model. But what is more, we add on a beta times T variable or term into this expected return valuation. And that's...
Ali, sorry, you have 5 minutes left.
Okay. I will put this most important slides and then quickly goes back to the result. Thank you for reminding me. So that's two variables plays a very important role that explains the whole story here, where the beta we just estimated from the previous step. So those numbers are the temperature beta, and those represents the unknown knowns. So that tells the impact of the climate risk on the asset classes. The delta T, it's really the unknown phase. And that is about the future pathway of the temperature change. So if we put this additional term in our assets or portfolio construction, we will see some very interesting results happening. Okay, so I will give a quick result. So again, for the temperature trajectories, we use the DICE model. And for the portfolio construction, we consider both pension funds that are DC with without liability constraint, so that is the asset-only portfolio, or DB plans that are asset liability portfolios with liability constraint. And in both cases, we're looking into how the strategic asset allocation would looks like in our results. So this I will spend the most of the time before the end. As you can see, we put asset classes into the bond, the stock, the T-bills, the cash, the bonds, stock market, alternatives, and the green assets. So the green assets is the part we want to focus on in particular. So those pattern bars represents to the scenarios or the portfolios that include the future temperature pathway from the DICE model. And as you see, as long as the future temperature global warming continues, there is a huge demand on the green assets. And that works not only for the asset liability or the DB plans, but also for the DC plans. And this is for the unrestricted portfolio. For the portfolios that with the short restrictions, you will see the picture even more aggressive, even without considering the future warming the path of the warming, we will still see a strong need of green assets. And if we're considering the unknown dimension, and you will see dramatic increase of the green assets, in particular for investors with longer horizon. So that is basically the very end of the story. So in this paper, one of the major contribution, I believe, is in trying to understand or explain what is the myth behind a green investment. Why do people don't believe that green can benefit their funds? And I think the reason is because this joint effect from the two phases of unknowns. And in another contribution, of course, is for practitioners. We develop a pathway to move towards green without sacrificing the rewards. That is the whole story. Thank you very much.
Thank you. Thanks for the excellent presentation. So very interesting idea regarding to the unknown. So so far I haven't received any questions from the audience. I just have a very quick question regarding to your definition about the green and the green asset. So in your slides, you just categorize all the stocks into the green asset. So and also the hedge funds. So I just wonder, for some stocks, maybe it's invest into some clean industry, or we say it's a green industry. How do you deal with those kind of stocks? Or maybe there are some kind of funds they invest into the renewable or some clean industry. So how do you deal with those kind of firms or funds?
Yeah, that's a great question. It's all about the matter of labeling them. So we eventually just pull up a whole list of existing instruments in the market, and ideally we want to put those most emerging and clean energy or ESG titled funds as define them as a green assets, and those more traditionally like those funds that has more than 80 or more than 90 years of historical returns. So we by now define them as a gray funds, but I know for a lot of those funds they are changing and they have been decarbonized, but that will be explained by the result as well. So if they're getting more green, you will see the effect from the beta. The beta will turning from negative to positive if you're seeing the time dynamics.
Okay, great, thank you. So I got two questions from the audience. The first question, what can be done to reduce the unknowns?
Okay, that is actually back to my dissertation. So the best way of deal with unknowns is to operate, to employ the operational resilience. That is to say, we want to always consider the worst case scenario, or say act under the worst case scenario. As the risk manager perspective, although we all fight against the climate change, but we dare to think about climate failure. Okay,
the last question. So what's actually the form of green assets? Debt, bonds, equity, ETF, what else?
Form of green assets. Yeah, that's so we also have green energy. So decarbonized indices included. We also include, let me check quickly. So you might find the details in the paper though. So we include basically most of the existing green instruments in our portfolio. Global alternatives, green technology, clean energy, etc.
Okay, great, thank you. Okay, so it seems like time is up. I would like to thank again for all the presenters for the excellent presentation, and thanks for all the audience for the comments and valuable suggestions. So that's all for today's, for this session, and enjoy the rest of the conference. Thank you. Bye.